I'm Greg Hunter. Welcome to USAWatchdog.com. Well, I think the Fed is in official panic mode. They've cut rates a half a point. Oh, and what happened? The market went down. And to have on to talk about who's been warning about this since at least, well, for a long time, but in 2018, he said they're going to stop rate cuts. They're going to reverse course. This is in 2018. They're going to reverse rate cuts. They're going to go back to QE. And boy, all that true. Said it on CNBC. It's Peter Schiff, much to their chagrin. They didn't like hearing the truth. But Peter Schiff, thank you for joining us today on USAWatchdog.com.
Oh, thanks for having me on again, Greg. And yeah, the stock market is selling off, but we rallied yesterday, right? We had an all-time record point gain. We had the biggest rise percentage-wise in the Dow since March of 2009, which coincidentally was the bottom of the bear market low from the financial crisis, the day the Fed announced QE1 for the first time, and that goosed the stock market. And we had the same move yesterday, anticipating the rate cut that we got today. But, it looks like the Fed's going to need a bigger rate cut because now they're selling on the fact, and the Dow is now negative on the day as we're speaking, a few hundred points.
Yeah, that's the line out of the movie Jaws. Looks like they're going to need a bigger boat. Looks like the Fed is going to need a bigger rate cut. I know that's your humor there. I know you have Schiff Gold and you have Euro Pacific Capital. Schiff Gold, you were saying in the pre-interview, this is a gift, man. It was down $60 on Friday, so I was buy, and sure enough, up $40-50 today.
Yeah, Friday was just like a gift from the investing gods, where for some reason gold sold off $50-60. I think it has something to do with the Japanese yen. Gold had been hitting record high after record high in the yen, and all of a sudden Friday you had the yen up 2% and gold down 4%, which normally those two move in the same direction. And I think maybe they hit some stops, or maybe some short-term traders got short. I don't know what happened, but they were giving those gold stocks away on Friday. I was buying more personally. I put more of my own money into my gold fund, the Euro Pacific Gold Fund. I'm the biggest shareholder in that gold fund, so the only cooking I eat is my own. But look, we have a big update today. We had an update yesterday, but it's still a fire sale as far as I'm concerned on these gold stocks. Nobody understands just how high the price of gold is going to go because they don't understand the box that the Federal Reserve has created. They're not cutting rates because of the coronavirus. I mean, that's what Powell said. Powell said, we're worried about how the coronavirus might affect the economy. Coronavirus has got nothing to do with it. That's not what they're worried about, right? Because cutting interest rates, if you are, planning a trip and you canceled your trip because you're worried about the coronavirus, you're not going to suddenly go on that trip because the Fed cut interest rates. I mean, if you're a business and your supply chain is getting bottled up because you're importing stuff from China and they're not making it because the Chinese workers aren't at work because they're worried about getting the coronavirus, the Fed rate cuts aren't going to put any more merchandise on your shelves. What the Fed is worried about is two things. One is the stock market, right? The stock market is falling. Now, maybe you could say that it's falling because of fears of the coronavirus. I think that's more the excuse. I think if it wasn't the coronavirus, the market would be going down for some other reason. But what the Fed is looking at is the stock market going down, and it's worried about the reverse wealth effect of deflating this bubble. And so it's the stock market that's got the Fed worried about the economy. So it's not cutting rates because of the coronavirus. It's cutting rates to stop the stock market from falling. It wants to blow air back into the bubble to prevent the reverse wealth effect from taking hold. And then the other thing they're worried about is the debt. Because of all the rate cuts, all the cheap money policies of the past, we are so massively loaded up with debt now. The governments, federal government, state, local governments, consumers, corporations, we have so much debt that if we have another recession, we have another financial crisis because people can't pay their bills. They can't service the debt. So the Fed is trying to get out in front of that by cutting rates to ease the burden of servicing debt. So really what they're worried about is a deflation of their own bubble. They're worried about stock prices going down, and they're worried about the wealth bubble blowing up. And so to cover up their own past mistakes, they're making the same mistakes again.
They say in China, I heard on, I believe it was Bloomberg, saying that they just told all the businesses, you don't have to make any payments until June. I think China's in big trouble, are they not? I mean, I've heard your old buddy. Well, he's still your buddy. Michael Pinto says they got 40 trillion in debt. I mean, they call it the red Ponzi. As David Stockman calls it the red Ponzi. I mean, China's in big trouble over there. I mean, I don't know what the medical effects are of this virus, but the financial effects are awful. Are they not?
Well, everybody's got debt, but in the scheme of things, I think we've got a lot more of it. The Chinese have a much higher savings rate. Personally, the Chinese don't have a bunch of credit cards where people pay cash for stuff that they buy over there. You don't have a bunch of people dependent on intergenerational Ponzi schemes for their retirement. The Chinese save for their own retirement. So I'm a lot less worried about the debt in China than I am about the debt in the United States. And, China has all the infrastructure, all the manufacturing capabilities. I think beneath the surface lies a very powerful economy, a very strong economy. Yet beneath the surface of our bubble, lies a disaster. So I am not worried so much about China. I'm worried about the United States. I'm worried about the U.S. dollar. It's the U.S. dollar that's falling today, not the RMB. I mean, the Chinese currency is actually up a little bit today against the dollar. I think people who are trying to pay too much attention on some of the problems in China or Japan or even in Europe are missing the forest for the trees, because we have got bigger problems. And I still think that we are at the beginning of the end of this fiat-based monetary system that the world has been on since really 1971. And America led the way to that system by conning everybody into backing their currencies with dollars. And we were able to do that because the dollar itself was not only backed by gold, but redeemable on demand into gold. And so we convinced everybody that the dollar was as good as gold. And once they trusted us, then we screwed them over and we pulled the rug out from under them and we defaulted and we closed the gold window. But the dollar stayed as the reserve currency, even though we had nothing backing it. And that is what powered this gigantic bubble where we were able to spend without producing and consume without producing and borrow without saving. And so we have benefited from this relationship, but it has exacted a toll on the rest of the world. And I think what's going to happen in this crisis is the dollar is going to lose that special privilege. I think gold is going to be remonetized. And I think central banks are going to start backing their paper with real money, gold again. America is going to have to do the same thing, but that's going to be much more difficult. And we're going to have to start living within our means, which means if we want to consume, we have to produce. Either we have to produce what we consume, or we have to produce something that we can trade with other people to import what they've produced. We're not going to be able to just send the world IOUs anymore. They're not going to give us their stuff for our treasury bonds.
The Chinese, they have reported a lot more gold than what you think. Some people estimate it's 20,000 tons. And, if they get into, deep enough trouble, that could expedite them saying, okay, you know what, y'all, we're going to back our yuan with gold. You said that 5 years ago. They went, oh, God, I'm never going to do that. Now, it looks a lot more realistic, like what you're talking about. Dollar loses its privilege, going to have to back it. The whole world's going to get off this fiat system. Could China lead the way in backing their yuan with gold?
Oh, sure. I mean, I think other central banks will do the same thing. But, speaking about gold, what China has in abundance right now are U.S. dollars and U.S. treasuries, which they can dump. You talk about, what if the Chinese economy is in trouble? If China is in trouble, their rainy day fund is loaded up with U.S. treasuries. We owe the Chinese, not the other way around. So if the Chinese economy is in trouble, we're in more trouble because they're going to turn to us. They're going to try to cash in these bonds. How are we going to pay them back? Obviously, the Fed is going to have to crank up the printing presses to buy up all the treasuries that the Chinese are getting out of. And by the way, they don't even have to sell. They just let the bonds mature. They weren't dumb enough to buy, 20, 30-year maturities. They have a lot of short-term paper that constantly matures, and all they have to do is get their dollars back and sell them for what they need. And now the Fed, if it wants to keep interest rates from spiking, just prints money. But, there is the bigger problem that no one is talking about. If the coronavirus actually has a great impact on the economy, the bigger impact, other than just a reduction in travel, which is, it just means that consumers spend money in a different way. If they don't travel, then they're going to stay home and they're going to do other things. But apart from that, the real risk is to supply of goods. if factories are not as productive because workers aren't on the job, because they're staying at home because they don't want to get sick or they are sick, right, then a lot of the goods aren't produced. So it's really a supply shock that is the result of the virus. Well, what can the Federal Reserve or any central bank do about that? Nothing. In fact, the right policy would be to shrink money supply. If the supply of goods is going down, then you should reduce the quantity of money. In fact, when the Federal Reserve was initially created, its mission was to provide an elastic money supply to the United States. And what that meant is that when the economy was expanding, the Fed would increase money supply. And then when the economy was contracting, it would decrease it, right? That's what they were supposed to do. And then they would have stable prices because money would expand and contract along with the economy. But what is the Fed doing? The opposite of that. The Fed is saying, hey, we're going to get a reduction in the supply of goods. Let's print more money. Let's create more demand for goods that are in even shorter supply. I mean, this is the classic Milton Friedman, more money chasing fewer goods. Prices are going to go up. They are creating massive stagflation with this policy.
Oh boy, and you think gold's going to go? I mean, some people think gold could be in the. I mean, Jim Rickards has said $10,000, and he also brought up much higher numbers, depending on how much you want to back the dollar with gold. You think gold could be in the thousands of dollars?
Well, no question about it. I mean, the question is how many. It's a moving target because all gold is really doing is measuring the purchasing power of fiat currency. So in dollars we're talking about, but there's no floor to how much purchasing power the dollar could lose. So there's no ceiling to how high the price of gold can get. I mean, obviously, if the dollar became worthless, then the price of gold is infinite. Because no matter how many dollars you have, you can't buy any gold. Now, assuming the dollar doesn't become completely worthless, it just becomes worth a lot less than it's worth today. If the dollar loses 90% of its purchasing power, then the price of gold has to increase tenfold to reflect that. So what's 10 times the current price? But whatever it's going to be, you don't know how much value, because intrinsically the dollar has no value at all, just a piece of paper. And so the question is, how much does the supply increase relative to the demand to hold on to that paper? And if you look at the amount of debt that we have and the amount of money that we're going to have to print to prevent that debt from going into default, so the government can meet all of its promises, both funded and unfunded, like obligations to pay Social Security and Medicare and Obamacare. I mean, if you look at all the money that's going to be created over the next decade or two, I mean, that's very scary. And so the price of gold is going way up. We don't have to know how high. We just have to know to buy it now, and we'll see how high it goes. But most people don't own any. They have complete confidence in the fiat-based system. They have confidence in the dollar. Now, that confidence is going to be shaken. It's going to be tested. And I think people are going to do the right thing. But most people are going to wait for gold to be well north of 2,000 before they start buying it. I've been encouraging my clients to continue to buy, through Schiff Gold. I mean, we're selling physical gold. And if you want to get, rich, I mean, if you're willing to take the risk, and I am, because I think the payoff is more than worth it, is these gold stocks, as I mentioned earlier in the interview. I mean, even with the rally today and the rally yesterday, gold stocks are still down on the year, despite the fact that gold's up maybe 7% or whatever it is. Gold's having a great year, but it's climbing a wall of worry. Nobody believes in this bull market. Everybody is skeptical. There's no froth at all. You can get these stocks, at bargain prices. And my gold fund, I think, is the best way to go. The Europe Pacific Gold Fund, EPG FX. There's several different symbols, but people can buy my fund at Schwab, Fidelity, E-Trade, a lot of different platforms. They could buy it directly if they go to my website, europacificfunds.com. People can just go to my website and get money into my gold fund. And yeah, I think that's the best way to go. And everybody should have physical gold. I mean, if you don't have any, buy it before the price gets even higher. But you may even want to, increase your position if you don't think you have enough.
What about the people out there now? What about silver? I got you on here. What about silver? It's like 90 ounces of silver to make 1 ounce of gold, or 87 or something crazy. What about silver? Is silver cheap? Would you buy it?
Oh, yeah, I am buying it. I have bought it. And silver stocks are even cheaper. See, the problem is now silver is being dragged down as an industrial metal. So people are worried about how silver might be impacted by a global economic slowdown. So people are thinking about it from that aspect, but they're ignoring the monetary aspect. And at some point, silver is going to shine again as a monetary metal alongside of gold. So at some point, silver is going to catch up and then surpass gold, not in price, but the ratio, right? So we're going to see a bigger move. So yeah, that's another more leveraged way to bet on this gold bull, because if gold keeps going up, eventually silver is going to come along for the ride. And so, but until then, I mean, gold will probably outperform until all of a sudden you have a big day where silver catches up. But before that day happens, buy it, buy junk silver. I mean, we sell a lot of silver at Schiff Gold. Just because the name is Schiff Gold doesn't mean we don't sell silver too. And, we have some silver stocks in our gold fund, but only a small amount because it's not a gold stock fund, it's a silver fund. But, individually in our clients' accounts, we still buy a lot of these stocks. And yeah, I think the 10 baggers, the 20 baggers, the 50 baggers, this is where they are, right? I mean, obviously there's going to be some of these stocks that go to zero.
Gold and silver.
Yeah, but some of them are going to go way up. I mean, these are ultimately going to be like the dot-coms, because at some point there's going to be a bubble in these stocks. We're not even close to that yet, but at some point they're going to be a bubble. And, that's when you'll be able to sell them. But I think that is years and years away.
And you could. We're back down to a position where you can buy a silver eagle for $20 with commission right now. You're back to $20 silver eagle coins. If you want to really be.
Oh yeah, well,
totally
silver's what, $17? I mean,
yeah.
Silver got up to $50 in 2011. How many things can you buy today that are that far from their 2011 high? And if you remember, the reason that silver got up there, and gold was about 1900, and gold's not that far from 1900, it's about 1650 now. But the reason that gold and silver went up so much is because people were worried in 2011 that, the Fed had, unleashed something that they could never rein in, right? They had done QE1, and people rightly were worried that, hey, wait a minute, this is going to produce lots of inflation. The Fed has slashed rates to zero. They're doing quantitative easing. This is a policy that can never be reversed. And people were right to be worried about where this was going. But then the Fed was able to convince everybody that their policy worked, that it was a success, and that they could easily normalize interest rates and shrink their balance sheet back down to where it was before the emergency, and the markets bought it. And then you had a collapse of gold. It went all the way down to almost 1,000. Silver went way down, and everybody started believing. The dollar went up because everybody started discounting the normalization process, all the rate hikes that were coming, the quantitative tightening that was coming. And the whole time, I kept saying, this is all BS. This could never happen. The Fed is describing something it can never do, because the minute it tries to normalize interest rates or shrink its balance sheet, the air is going to come out of the bubble. And so then what are they going to do? They're going to try to blow it back in. That's why I said if they ever try to normalize rates, they're going to fail, and they're going to have to reverse the process. I said if they ever tried to shrink their balance sheet, before they shrunk it very much, they'd have to reverse the process. And that's exactly what they've done, right? They're back to QE, even though they don't want to call it QE, and they're cutting rates. And, we're back to 1.25 to 1.5. I mean, what was the highest they got? 2.5? That's nowhere near normal. How small did they make the balance sheet? Not even $3.5 trillion. And now it's back above $4.25 trillion on the way to the stratosphere.
What about the stock market? You hear people, I'm going to be a long-term investor. They look at Monday and go, oh, look, that's investing. I'm going to be a long-term investor after, 4,000, 16, 15% drop in a week. And, when is the stock market a good place to be a long-term investor or not?
Look, everyone's a long-term investor until they need the money. And then what happens when you need the money? And what happens if everybody else needs the money at the same time? This is a giant Ponzi scheme or a pyramid, right? Because the stock market just reflects the price, because you can't live off the dividends, right? If you could just live off your stock market dividends, that'd be fine. But the dividends are so low because the stock prices are so high. So the only way people can retire off of their stock portfolio is to sell shares. Or if you lose your job or you have an emergency and you got a bunch of money in the stock market, you need to sell your stock in order to raise the cash that you need. Well, somebody has to buy it. But if everybody is stuck in the same emergency, if everybody is going through a recession, if everybody, people lose their jobs and they need money, or if the baby boom is starting to retire, who are they going to sell their stocks to? The millennials have no money. They're not going to buy any stocks. So as long as we all pretend that we're rich because we have a bunch of stocks that pay very low or no dividends, and we all agree not to sell them, we can all pretend that we're rich. But the minute we need the money, the wealth evaporates. All that paper wealth is gone. So people should be getting out of these overpriced U.S. stocks. And if they pay dividends at all, they're paying dividends in dollars that are going to lose a lot of value. They should be in physical gold. They should be in better valued stocks. That's what I've been buying for years, is I'm buying low value or high value, lower price stocks relative to their book value or their earnings, where we get high dividend yields that you can actually live on, where you're not depending on a greater fool to buy your stock at a higher price. You bought into a business, like Warren Buffett likes to say, at a good value. And now your reward is you're sharing in the profits of that enterprise by collecting dividends. You never have to sell the stocks. You could just use the dividends that the businesses are generating. And more importantly, I'm generating dividends for my clients in Swiss francs or in Norwegian krona or in Singapore dollars or New Zealand dollars, whatever it is. I'm getting dividends in currencies that are going to retain a lot more of their purchasing power. And of course, a lot of my gold stocks, most of them pay dividends. And all these stocks are going to be increasing their dividends because the price of gold is going way up and the cost of mining it right now has been going down. Look at oil coming down. That is a big cost of mining. So these mining companies are going to be cash rich and they're going to be paying dividends, higher dividends than they're already paying.
And the overall stock market, the S&P, you think it could go down much farther from here? What's your price target on the S&P or the Dow or whatever it is?
Well, again, it's hard because it's a moving target because they keep debasing the dollar. So the stock market is going down. If the dollar is going down too, if the dollar goes down faster than the stock market, then on a relative basis, it looks like the stock market is going up. But I've had a price target on the Dow, pretty much since 2000 bubble of 1-to-1. So the Dow is what, 26,000, and gold is what, 1650. They have a long way to go before they're both the same price. But, it could happen at 10,000. It could happen at 50,000. I don't know where they're going to meet, but I do think at some point they're going to get to 1-to-1. Now, maybe they only go to 2-to-1, but that's still a big move in terms of the Dow's price in real money in gold. But as far as how far the Dow is going to fall in terms of dollars, paper dollars, there's no way to know. I mean, if the Fed prints enough of them, they could stop the market from going down, but only by destroying the value of the dollar.
And we started this off with the Fed's going to need a bigger rate cut, just like in Jaws. They need a bigger vote, which is a funny thing. You tweeted it out to your people, which is funny. But you think we're going to go to zero on the rate cuts?
Oh, yeah, I've thought that since long before the coronavirus. I mean, the minute the Fed raised rates for the first time, the minute Yellen hiked rates 1/4 of a point, I knew it was only a matter of time before we were right back at zero. And in fact, the reason I think it's taken so long is because Trump won and was able to do the fiscal stimulus and inflate the bubble a little bit on that side. And that provided the cover for the Fed to get a few more rate hikes under its belt. I think had Hillary Clinton won, that might have been the only rate hike we had, and we would have been back to zero a lot sooner. But, it's not that we need a bigger rate cut as if the rate cuts are good. They're not. The rate cuts are harmful. I mean, they're not going to cure the coronavirus, but they are going to make the economy sicker. But the Fed is going to go to zero because they're going to keep cutting rates. The problem for the Fed now is that they just gave the markets a 50 basis point rate cut, and the market's selling off. I mentioned that on my own podcast when I did it yesterday, when I said, hey, the Fed's about to cut rates 50 basis points. But I said the danger is, what if it doesn't work? It's like, those movies where you have Superman and the villains see Superman and then they pull out their gun and they start shooting him in the chest, and then the bullets bounce off, and then they realize, I'm in a lot of trouble here because I just shot this guy and it didn't do anything. Right? I mean, sometimes they throw the gun at him, but obviously that's not going to work if the bullets don't work. But if the Fed comes out with a 50 basis point rate cut and the market goes down, what do they got left? It didn't work. They're going to do it again. You can only do it 2 more times and you're back at zero.
That was a bad day. It was like in the middle of last week, when it went up 400 points and it ended up down 123. I thought that was the worst day of the week because they gained the hill and they got blown right off it. And now here we have, with this roughly 1,300 point, freak out, the cartoon on Monday, and then they cut rates, which should just drive it higher, and boom, everybody sell, sell, sell.
And the other thing that they're overlooking, look, before the coronavirus, even was entered into anybody's vocabulary, the stock market was massively overpriced.
Yeah.
It was way overvalued. This has been the longest bull market in history, and it's the most expensive. I think the U.S. stock market was and remains more overvalued than it was in 2000 or 2008. So the market was going to go down anyway, right? If it wasn't the coronavirus, it would have been something else. It's not, I've been saying, it's not the size of the pin, it's the size of the bubble. This is a massive bubble. It finally found a pin. And I don't even think it matters going forward what happens to the coronavirus, because once the bubble is pricked, it's pricked, and the air is coming out of it. And for everybody to say, oh, the Fed has to panic and cut rates because an overvalued stock market is slightly less overvalued, it just shows how the Fed knows that this whole economic recovery was an illusion. Donald Trump was right when he ran for office and said it was a big, fat, ugly bubble. It was, except now it's bigger, fatter, and uglier. And, the air is coming out of it.
And you wouldn't tell people to buy and hold for the long term. You'd say run, Forrest, run. You'd say get out,
it depends
sell.
It depends what you're buying. Look, if you
a lot of people are in mutual funds where they're buying the whole market. They're just.
I would not. No, the whole market now is dramatically overvalued, right? If you get a chance to buy the U.S. stock market at a very depressed level, let's say the dividend yield gets up to 6, 7, 8%, right? If you could buy the market at below book or something, in a bad recession where there's blood in the streets, and maybe you think that we're going to finally, swallow some bitter tasting medicine. Yeah, if you buy stocks at the right price, you can hold them forever. I think a lot of the stocks that I'm buying now for my clients, they can hold them for a long time. They can leave them to their kids, because I am not chasing bubbles. I'm buying value. I'm buying assets that I think will provide a safe haven in an inflationary environment. It's not just the U.S. that's going to experience inflation. It's going to be the entire world, because everybody's been creating too much money. Everybody's kind of operating from the same playbook. So you have to have a hedge. You have to own real assets, but you don't want to overpay for them. And you also have to make sure that the stocks you're buying are going to survive and they're not going to go out of business. There are a lot of stocks that people think they're buying for the long run. They're not going to be around for the long run, because they're going to go bankrupt in the short run.
And you also, just so you know, in Schiff Gold, you have the Euro Pacific Capital stock, banner behind you, but you also have Schiff Gold. You sell physical. So if you don't want to buy stock at all, you don't trust a brokerage, you can always just go buy physical gold and silver and buy quality, right?
Yeah, I started with the Perth Mint, and I still do that through my broker dealer. We still sell gold through the Perth Mint in Australia. I started doing that in 2002. Right, the price of gold was below 300. My clients were buying silver for $4 an ounce, $5 an ounce back then, right? And yeah, we're a lot higher now, but there's a lot more money now. They've made a lot more mistakes since I first started offering physical gold. It wasn't until about 2010 that I opened up Schiff Gold and then started selling where we physically ship you the gold. In the Perth Mint, we have the Perth Mint store in Australia. But Schiff Gold, we deliver it right to your house. We could also arrange third-party storage, but people should have gold and silver in their own possession. And then I believe they should have some of it stored, particularly outside the United States. It's like an insurance policy. You hope you never need it. But look, we elect Bernie Sanders. I mean, maybe the odds are a little bit lower now with everybody backing Biden. But look, we go down that direction, right? We get a socialist president. You never know. You may need to flee the country one day. That's how this starts. It's a camel's nose getting under the tent. And it's nice to know that you've got some gold offshore waiting for you when you leave.
Peter Schiff, thanks for joining us today. Really appreciate it. It's Peter Schiff at Euro Pacific Capital, also at Schiff Gold. The links to your websites will be in the after the interview section. Peter Schiff, thanks for coming. Before we go. Yeah. The mainstream media doesn't have you on as much as they used to. Of course, you've been right. And, we were talking in the beginning, you were on Liz Clayman's show saying, all the stuff that I said at the beginning, that they were going to have to stop rate raising. They're going to have to cut rates. They're going to have to go back to QE. Yep. And all the guests on there used to argue with you. And I heard they were on there going, I like my stocks. I like turtles. I like turtles. I like stocks. I'm going to make my trades. And you're on there talking PhD stuff, and they're in the sandbox playing with their, I like my trades. Are you getting that they're taking you serious and they're at least respectful, even though they probably hate your message because they want to sell stuff?
Well, it depends. Fox is getting a little better. I have been doing some more Fox business. I got a call just before this interview from a guy at Fox. I was on Fox News, as a matter of fact, last night. I was on, or Monday night rather. I was on Fox News. So I haven't been on Fox News in a while. You can actually see the interview up on my own YouTube channel, Peter Schiff. I put the interview up there. In fact, about 2 weeks ago, I taped an episode or whatever, a segment with Tucker Carlson on the Fed. And I was very critical of the Fed, and Tucker agreed with me. And for some reason, they haven't run that yet. They have it on ice because it's in the can there. They recorded it. So maybe they'll air it, or they'll bring me on to do a fresher one. But yeah, I have been getting some more air time now on Fox and Fox Business. So hats off to them. And maybe they'll have me on with more regularity. CNBC, I think, is hopeless. I mean, they gave up on me a couple years ago, and they just want to pump every bubble they see, from the stock market to Bitcoin. They don't want anybody on that has any kind of sensibility there. Bloomberg, of course, though, Bloomberg was the first major network to ban me. That was about 10 years ago, and I used to be on Bloomberg more than any other network. But CNN, CNN headline news. I mean, I used to do all these shows, all these different networks. But now slowly I'm coming on, and some of the, the not mainstream, One America News now has me on once in a while, and I do this stuff, RT. So, a lower tier of news, calls me up and has me on. But the more major, more mainstream ones are still shying away, with the exception now of Fox Business. And so, hopefully that continues, and, you people can see me more there. But of course, you don't need, when I first was starting, when I was going on television in 2004, 5, and 6, I didn't have a podcast. I didn't have a YouTube channel. I wasn't on Twitter. I was nowhere. So the only way you can hear me is on those, mainstream networks. But now I probably have a bigger daily audience for my podcast than any of those shows anyway. So you don't need them. They're not the gatekeeper anymore. You can go directly to my social media. My podcast is free. The YouTube channel is free. All that content is there. I can go on shows like yours. I mean, you're doing great. You didn't exist back then, or if you did, I mean, you were very small. Yes. But now you get a decent audience that you've built up, and that's, hats off to you for doing that. And we have outlets like yours, and and there are other online shows that I participate in. So we don't really need the mainstream media. The free market is making them obsolete, because no matter how much they want to keep this perspective from getting out there, it's getting out there anyway.
Yeah, free market, that's very good. The free market is making the mainstream media obsolete. Yeah, I used to work at ABC News and CNN, and I worked at CNN when they called it the most trusted name in news. And what they do now is, I don't even know who's running the anyway.
I'm gonna up my game on it. I've told you I'm building a studio. I haven't started yet. Everything is slow here in Puerto Rico, but I'm gonna build a studio on my property, podcast studio, audio video studio, so that I can do a lot more video content, and maybe have some programs, and who knows, maybe have an entire network one day of freedom and liberty and a different perspective. People are certainly going to need that during this next crisis, because it's going to last a lot longer than the Great Recession of 2007, 2008. So it's going to be a lot longer. It's going to be a lot more disruptive. And so I think in that environment, a lot of people are going to be searching for some answers that they're not getting from the mainstream media. I mean, the media doesn't even know what questions to ask, let alone explain what the answers are. So I think a lot of people are going to be looking online, and I think they're going to find me.
Yeah, I think they are too. And you were very gracious to come on and share, your time with us. You're one of the favorites here at USAWatchdog.com. Peter Schiff of Schiff Gold and Euro Pacific Capital. Thank you very much for joining us today on USAWatchdog.com.
Yep, my pleasure.